Nvidia announced their earnings today, and I was able to review their financials and update my analysis on this company. I wanted to share that with you. Overall, Nvidia has had an incredible journey for 2.5 years, and their stock has really flourished. This year, the company has had its ups and downs, but more recently, the stock's really gone up. The earnings that were reported today were really impressive. The company grew year over year by 69%, and they grew sequentially by 12%. The total revenue in the quarter was 44 billion, which was a very high number. The only blemish that I saw in the earnings was that the margins did go down to 60.5%, which was lower than expected. They're doing about 75% margins. And that was likely because they had to write off some inventory that they couldn't sell to China, if you recall, a month or two back. The outlook for the next quarter, which would be their second quarter of their fiscal year, is that they're going to do $45 billion in revenue. It's going to be sequentially a very small growth rate, but compared to the prior year, it's still going to be a sizable growth rate of about 50%. When we look at their financials look really good. The income statement looked good with the exception of margins, which were lower than expected. And earnings per share was lower than originally expected at the beginning of 2025. Their cash grew nicely on the balance sheet up to 53.6 billion, and their debt didn't really grow at all. So they have more cash now to work with. Their cash flow really expanded. Cash from operations went from 15.3 billion to 27.4 billion dollars in the most recent quarter, which was a big jump, really impressive. And their capex isn't very high. They're a fabless semiconductor company, so they don't have to build foundries to make their semiconductors. So the earnings overall were really impressive. Let's take a look at other fundamentals for Nvidia. If you enjoy content like this, consider being a paid member of my channel. You get a list of perks that you can get more details on if you visit my home page, and I'll provide a link on the description of this video. Thank you. So the company market cap is $3.3 trillion, and the stock is working in the after hours. It's up 4.32%, so it's going to be much higher than that tomorrow when it trades. Its PE is 45, which is fine because it's a high growth company. Analysts think it's discounted by 26%, and the stock for the past year is up 26%, and it's seen a lot of volatility, especially some really down prices at certain times. And most recently, it hit $94 a share, if you recall. It hasn't closed above $150 in the last year. It seems to have an issue getting above $150 per share. When we look at their financials, the growth looks really good, but the sequential growth will begin to slow down. If we look at this quarter is at 44 billion, they're expecting they're going to be at 45 as an example. So that's just $1 billion of sequential growth. Pretty soon, they're going to be flat. And I expect in a year or two, they're going to actually have a contraction in revenue. That's just expected because the AI build out is going to slow down at some point, and probably they won't need as much compute in the future because they would have already built it out. Gross margins, it's mentioned, they really did come down, but cash flows really rose in the quarter. Really impressive. When we look at the forecast for the company, 41 analysts voice an opinion, and they believe the stock is discounted by 26%. Even these analysts believe that the stock will begin to contract in a couple of years, represented here, that they'll begin to contract in the fiscal year 2029, which is roughly 3 years away. I think they're probably going to start contracting in this year because the data center build out will be affected by more competition to Nvidia, and I think companies will slow down their spend of CapEx for AI. I'm going to use the numbers reported and agreed to by most analysts, and the consensus is $4.43 for the current year. I'll use that number. And I'll use a growth rate of about 20% going forward. Nvidia is a really desirable business. It really belongs at the highest level of my desirability quadrant. The green is where the companies landing in the green are most desirable, and Nvidia most definitely is in the green. The reason for that is when I scorecard their desirability, which is a measure of their moat, their competitive advantages, as well as their growth, profitability, and cash flow. And their moat is excellent. They have really no competition when it comes to GPUs. Their technology is the best. The network power, they don't have a network like Microsoft or Apple. So I gave them a B in that area. Balance sheet's excellent, it's an A. They are growing really well, very profitable, produce tremendous cash flow. So A's across the board on that particular criteria. So when I measure them, they just are a very desirable business, as opposed to businesses that aren't growing anymore, are lacking profitability, like GrowPro, which used to be a growth company, but not anymore. They're pretty much kind of left in the rearview mirror. Now let me go over my evaluation of NVIDIA, and I'm going to give you two different points of view. First one is on cash flows, and the second is on earnings per share. The cash flows for NVIDIA are incredible right now. And for the next 2 years, I think they're going to really produce a lot of good free cash flow. In year three, I expect cash flows are going to begin to slow down. And I'm starting with the trailing 12 months, and I'm adding 15% in year one and year two. But in year three, I think they're going to start coming down by 10%, and in year four as well. And then terminal value will grow at 4%. So all those cash flows, I want a net present value of those cash flows. So I'm going to discount them by 8% to get to a net present value of $1.64 trillion. I'll add cash, take away debt to get to an equity value of 1.689 trillion. So that's much lower than their current market cap of $3.2 trillion. In fact, it's 49% too high. So the stock price is 49% too high if you compare the stock price to the value of the stock if you measure the free cash flows I expect from Nvidia. Earnings per share paint a different story, which is that earnings per share really show that the stock is actually discounted by 30%. And that's one way to look at the valuation of a stock. But most super investors really depend on free cash flow discounting. And that's what I depend on. So it really leaves an investor a choice. If you really believe in Nvidia, then you can probably substantiate and justify buying the stock and holding the stock. But in my case, I have to look at earnings, free cash flow, and free cash flow says that the stock is much too expensive. So for me, Nvidia is a sell, and I would not be buying Nvidia shares. I'd actually be selling them. I don't currently own Nvidia shares, but that's how I look at the stock. So that's my review of Nvidia. Exciting news from this company, and that is my point of view on Nvidia. Hope you found it interesting, and I appreciate you watching.